everyone, William here from Smartest Data. In these videos I'll discuss portfolio construction, commentary on US equities and stock valuations. Look, I'm a registered investment advisor here in Switzerland and also under the Central Bank of Ireland. So how is this all done? Well, we screen for stocks. In this case, the stocks discussed in the final trade segment at the end of the halftime report on CNBC. So there's a panel of experts there. So these videos are to explain how to invest in stocks, whether you're an independent investor or working alone or collaborating with a broker. It's just to give you more information, to have a greater understanding of what they're saying to you, what the industry is going on about. Okay, the videos are targeted investors with a longer term mindset, as valuations and company information can fluctuate, but it's not really targeted for day traders, but I'll get onto that. The videos are here to help you understand investing, the concept of valuation ratios and the information they offer, and how to constantly evaluate a stock's valuation. Okay, so as I mentioned, are these videos for day traders? Well, no, not really. Other intraday factors influence what they trade on a day-by-day basis, but I would say that short-term traders can get to understand the dynamics overriding any day-to-day price movement. So this video is actually created in conjunction with Finscreener. It's an online data source that I use to follow American equities and perform back tests, so on and so forth. So there's a variety of tasks. It's simple and convenient to use. The link is in the description below. If you wish to subscribe to Finscreener and follow me, by all means. Also the links to the online brokers, ETORO, FX Primus and First Trade, they're also there. In this video, I do a quick discussion on the US equity stock market and what's going on with the indexes as they bounce back from correction territory. A review of this week's portfolio, the 42nd for 2023, the portfolio construction process in Finscreener, my portfolios, and also using access to monitor the investment universe and the overall watch list. Investors' concern receded as the major U indexes, which were nearing correction territory, bounced back strongly, around about 5% on the week. The three main indexes swept their highest weekly gains of the year so far. The Dow was up 5.1%, the S&P 500 was up almost 6%, and the NASDAQ was up 6.6% on the week, and the Russell 2000 beat them all, up 7.6%. The weekly movements took the Dow up by 5%, as I mentioned, and this was the largest weekly performance since October 2022. While for the S&P 500 and the NASDAQ 100, it increased the largest weekly gains since November last year. Okay, so all the sectors were up. Consumer staples are up 3.3%, utilities are up 5.2%, financials up 7.4%, telecoms up 6.5%, healthcare 3.5%, industrials 5.3%, IT up 6.8%, materials up 5%, energy up 2.3%. It's been doing well recently. Consumer discretionary up 7.2% and real estate up 8.4%. So as the earnings season continues, there is the underlying level of support for stocks. So let's go over to Finscreener and take a quick look at what we have. So we're inside of Finscreener here, and you can see here we're inside of, so we're almost through, but this week there's quite a few companies which are still listing. Let's go over to the NASDAQ and take a quick look. So you can see the companies which are coming up this week. So all in all, I would say that if we look at the earnings reported and go over there for the NASDAQ, for example, all in all, it's been quite positive. And that's what we can see, is that the Q3 earnings season has in general been quite favourable. On the companies reported, over 82% have beaten their forecasters are optimistic that the Fed funds rate rises have ended. The markets are factoring in a 5% likelihood of a rate rise, 25 basis points the next, which means it's just not going to happen. That's on December 12th, 13th. So the Fed is probably done, but keep in mind the long end of the yield curve. This is where the rates could continue to rise. If this does happen, it will have the biggest impact on investors in 2024. So that's the thing to watch. The markets are anticipating that the FOMC will start reducing rates by mid-2024. So Poorer than expected jobs data released on Friday. This strongly suggests that the Fed's efforts to curb inflation and slow the economy down is working. This is part of the investor optimism that we saw. This week we saw a sharp decline in bond rates, with the 10-year Treasury falling down to 4.75% from 5.3% the previous week. Also, the 2-year note fell sharply on Friday by 15 basis points. So the US unemployment report provided a solid piece of economic data to indicate the US economy is slowing. In October, the US payrolls rose by 150,000, weaker than expected. That was expected 180,000. The October US unemployment rate rose by 0.1% to a 20-month high of 3.9%. The labour market is weakening, and that's the expectations was to be unchanged. So with that said, let's get on to the first portfolio, the 42nd portfolio. This week it has 8 stocks. It's done in conjunction with Finscreener in my portfolios and also with Access. So let's take a quick look. So onto the portfolio construction process, and remember, this is just a simple 10-step process, and we do this to be able to follow the stocks. So there's 8 stocks in the portfolio for this week, starting from Apple, Microsoft, Google, Meta, Bank of America, Boeing, Arista, and Apollo Global. Okay, so now we have the portfolio constructed, all the stocks inside, and we can take a look at the diversification. So this week, technology is 37.5%, communication service 25%, financial services 25%, and then finally industrials with Boeing at 12.5% of the portfolio. If we look at the earnings ratings, on a strong buy is Boeing, and then on neutral is Apollo, Bank of America, and Google, and then on a strong sell is Arista, Apple, and Microsoft. Anyway, if we look at the analyst ratings, we can see that on a moderate sell, there's Arista, Apollo, Bank of America, Apple, and then on a strong sell, Bank of America, Google, Microsoft, and Meta. If we go down, take a look down the portfolio, so we can look at the actual asset allocation, and you can look at the allocation of all the stocks there. Then if we move on down to the distribution by, so on the technology, we have the 3 stocks, Arista, Apple, Microsoft, split into Microsoft in software and hardware, Arista and Apple. Financial services, there's 2, so asset managers is Apollo Global, and then banks is Bank of America. Onto industrials with Boeing in aerospace and defense, and then also communication services, interactive media is both Alphabet, Google, Meta. Okay, then so finally down onto the stock with the greatest upside, we can see here that Bank of America has the greatest upside at 46.5%. The stock is currently trading on around about $28, $28.40, and the highest would have it up around about 55, and the lowest around about 32. So that's a portfolio construction process. Onto our database, which we keep inside of Access. So we enter the stocks into Access as we do into my portfolios inside of Finscreener. So here we go, entering all the stocks in, and at the end of this, you can see when the 8 stocks have been recommended in previous portfolios during 2023. So finally onto the watch list, and the watch list is our investment universe, all the stocks which have been recommended so far in 2023. It's an important way to track a portfolio. So if you look at the little hand here, you can actually take up and look at downloading it into Excel. Now, I've got about 157 stocks in here, but what shows up here is just 100. So I'll just scroll down for you, and you can take a look at all the various stocks. Stop it wherever you wish to see the stocks in the portfolio. Okay, so let's take a look at the stocks. So we've got a couple of stocks which are coming up. So Apple and Google. I'm quite comfortable with where Google is, but Apple, I think, you can see with the issue of the results, it wasn't good. So let's take a look at Apple. So Apple, the ticker is AAPL. It's a 2.76 trillion market cap company, currently trading around about $176. Apple's revenue announcement was met with a 3.4% fall in the stock price. This was the 4th quarter in a row that it had negative earnings. Positives include a 3% rise in iPhone sales, better than expected profitability, and strong service performance. Okay. Developing markets and a successful services sector seem to be the key to Apple. Investors are not impressed with management forward projections. Revenue for Q1 will be similar year on year. Not good enough. Apple is an innovation company. In the past 12 months, it's up 28%. Year to date, up 36%. It's got a forward PE of 25.7 times, current PE of 21.2 times, price to book 41 times, price to sales ratio of 7.7 times, and price to cash flow of 17.3 times. I couldn't find a peg on. Okay, so let's go over to Finscreener and take a look at where we are with Apple. Here we are inside of Finscreener and we can see the graph for Apple. It's sort of been bounding along the side. But as we sort of said, look, I think the PE ratio is way too high. Apple's an innovation company and it frankly has not been innovating recently. And this is the issue which investors have with Apple. If we look at the PE ratio at the moment, the current PE ratio, it's sort of, mid-range, but Apple's a growth company. It's expected to grow at about 11.5% or so. If we look at the forward PE, it's on 25 times, and that's way higher than the average. Look, if Apple is not innovating like it did under Steve Jobs, and I think that's the big issue that we've got coming out here. I mean, Apple really has to keep innovating to be a successful company, and that's what we've got to start to look at. So let's start to go over to the next stock, which will be Google. So Google, the ticker is GOOGL. It's a 1.62 trillion market cap company, currently trading around about $129. The Q3 earnings failure from Google caused a stock drop of around about 10%. A beat on EPS and sales, whilst operating income fell short due to increased R&D expenditure. The business is benefiting in AI and the cloud because of the potential benefits of the ramp up and rollouts anticipated in 2004. It lost around about 160 billion in market cap. Despite this, Google's cloud is increasing market share and turning a profit. Google Cloud is expected to expand operationally earnings by 14 times by 2027. So that's a 70% per annum increase. Currently it's around about 20%. So over the past 12 months, the stock is up 52%, year to date 46%, forward PE of around 18.4 times, current PE of about 17.4, price to book of 4.5, price to sales ratio of 2.5, price to cash flow of 12.5, and a PEG of 1.3. Let's go to Finscreener and take a look. Okay, so let's start to take a look at Google. Let's go over to Finscreener and have a look at where we are. And here we can see we're inside of Google with Alphabet. I call it Google because frankly most of the profits are coming from that. So I think at the moment, if we look down the valuation parts for Google, if we look here, it's not expensive. It's 17.4 times for this year and 18.4 times for next year. And it's on PEG ratio of 1.13. So I think Google's got some legs to go in this business. Okay, so that's it for this week. So thanks very much for tuning in. Look, if you like these videos, like and subscribe to the channel. Also, if you want to subscribe to Finscreener, the link's in the comments below. It really would help. I will get a small commission, but you also be able to follow the work which I do as far as my portfolios go, etc. And also the e-brokers, so eToro, FX PRIMUS, and also First Trade. So please, by all means, as everyone says, like and subscribe. It really does help the channel. See you next week.